And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Welcome to today's edition of The Real Investment Show. It's our continuing interview sessions that we've been doing here now for a while here on the Real Investment Channel. Of course, I'm your host, Lance Roberts, and today our special guest is Parker White, CFA. He's the operator, investor, and engineer in crypto since 2017. He's a Kraken alumnus. He's also, after receiving his CFA, he entered into the crypto space in 2017, running an algo trading startup through 2018. He's been active in Solana since 2021. He's been an angel investor in crypto since 2020, and he sits on the advisor board at TVP for the Bitcoin Venture Fund series, and just a lot of background in crypto. So that's what we're going to be talking about today. Parker, welcome to the show, sir.
Thanks for having me.
Absolutely. So, look, let's take this a little bit from the start. Again, kind of some of the space that you're in particular in the crypto world is a little bit new to some of our listeners. A lot of our listeners and our followers on our YouTube channel and our readers, they're familiar with Bitcoin and Ethereum and how it trades in the markets. But kind of what I want to get into a little bit with you today is what's happening behind the scenes with crypto. There's been a lot of talk over the years about how cryptocurrencies are going to become kind of the next thing. It's kind of a DeFi transition away from traditional fiat currencies, et cetera. But we've heard a lot of talk, and we haven't seen a lot of development in terms of things, but that's coming, and we're seeing a lot of it, and you're involved right in the middle of it. So can we just start kind of at the beginning of kind of where you're involved in the space, what your focus is, and kind of where you're headed to right now?
Sure. Yeah. So appreciate the background, the introduction. I've been in crypto for quite a while, since 2017. Most recently, myself and a couple other former Krakenites, we launched the first ever non-Bitcoin treasury vehicle. Some people call them DATs, digital asset treasuries. So you can kind of think Microstrategy, but for another asset. And so ours is built on Solana, and Solana is, I'd say maybe roughly the third largest asset out there by a lot of different metrics. And so we've built this kind of treasury plus operating business on top of Solana, the asset. And that's because we think that Solana has a lot of upside potential and a lot of room to grow in terms of usage and adoption and some of the things you talked about, like, hey, we've seen some adoption, but there's still a long way to go to kind of reach its full potential.
Can I stop you real quick, Parker? Because
Sure.
you brought up two things real quick, and again, for just the context of our listeners who may not be as familiar with digital asset treasuries, in particular, we've seen with MicroStrategy, and then recently with the company out of Japan, the kimono maker, that has now become a Bitcoin treasury company. Could you explain exactly what is going on there and help people understand what's happening with MicroStrategy? And we'll just use that as kind of the key case. What's happening with MicroStrategy, and then how is what you're doing a bit different than that?
Yeah, so with MicroStrategy, the simple idea is, rather than holding a bunch of cash and treasuries on your balance sheet as a company, you just instead hold Bitcoin. Seems simple. You could also hold gold. You could do other things, but MicroStrategy is holding Bitcoin. But it creates an interesting dynamic where they're able to grow their Bitcoin per share accretively or pretty quickly. So the way that works, and I can dig into that, is essentially the stock trades at a premium to the Bitcoin on the balance sheet. So they've got, I'm going to use kind of round numbers. They've got 50 billion of Bitcoin, but the market cap of the stock is 75 billion. And so what they do is they will sell stock. They'll also issue convertible bonds. And now more recently, they've been issuing a lot of preferred stock. So they sell these securities into the market, and then they buy more Bitcoin. And so you as a shareholder, maybe on day one, you have 0.1 zero point zero 0.01 Bitcoin per share. But then over time, as they raise capital, now you have 0.015 Bitcoin per share and then 0.02 Bitcoin per share. And so as an investor, you can you've got two different options. You can just go buy some Bitcoin, a unit of Bitcoin out there. You put your $1,000 into some Bitcoin, it just sits there and it doesn't grow. Bitcoin doesn't generate yield. It just kind of is there, which is fine. Gold does the same thing. On the other hand, you could buy shares in MicroStrategy, and over time, those shares are going to represent more and more Bitcoin as MicroStrategy taps into the capital markets to raise capital. Now, the criticism of the model will be like, well, he's just like selling equity and when it's at a premium, but what if it goes, 1-to-1, 1x NAV, and then you can't issue any more equity at this premium, the whole thing kind of breaks down. And that's partly true. On the other hand, he's able to issue preferred shares, he's able to issue convertible bonds, he's able to issue securities into the market that me as an individual, I just can't do, right? And even hedge funds can't do, right? As a hedge fund, you can't go raise $1 billion via convertible bonds into the market. Like, that doesn't work, right? So Michael Saylor's cost of capital is much lower than the average investor and, even hedge funds and other like funds out there that might buy Bitcoin. So he's got the structural advantage. Now, the other advantage, though, that these treasury vehicles have is access. Right? So if you're a pension fund, if you're a mutual fund, if you're all these different pools of capital, you may not be able to buy Bitcoin directly. And yes, there's now Bitcoin ETFs. And so that certainly helps things. But even still, in some cases, for example, mutual funds have a mandate to buy, for example, stocks or bonds. They can't go buy an ETF. And certain pensions can't buy too much of an ETF. Right. And so there are structural limitations to getting exposure to Bitcoin for certain pockets of capital that a simple ticker on the NASDAQ or a ticker on the NYSE can solve. And you mentioned Japan, the Kimono company, and obviously Metaplanet is the well-known one there. There's a weird tax structural issue there where if you buy crypto directly, you pay giant capital gains tax. I believe it's 50% capital gains tax. If you buy stocks, I think it's like a 0% capital gains tax or a much reduced capital gains tax. Right. And so as a Japanese investor, you're like, well, 50% or much lower here, but it's the same thing, right? They both give me exposure to Bitcoin. And so Japanese investors have been buying Metaplanet like crazy because it's like one of the #1 traded stocks in Japan because of this, tax imbalance.
Yeah, that arbitrage. So, but exactly. So walk me through here. So you've given me kind of all the advantages, and let's stay with MicroStrategy for a second because it's well known here in the States. Everybody knows who MicroStrategy is. Michael Saylor's been everywhere. But what happens? What's the disadvantage? At some point, if somebody says, you know what, I need to get paid back, right? I bought your convertible bond and, I need my money back. What's the risk? Because Michael Saylor's been very clear. It's like, I'm never going to sell Bitcoin ever. Okay. But your business, MicroStrategy itself, right? It doesn't produce really any revenue. When it was just selling software, it was kind of heading towards bankruptcy eventually because of just its business model. And if he's never going to sell Bitcoin, then at some point, how does he generate the ability to return capital back to shareholders when or if that ever occurs? And that's because again, this is a bit of a leverage play on Bitcoin through micro. So what kind of way to play a leverage through MicroStrategy? So what's the risk there for investors that are buying MicroStrategy to get that exposure to Bitcoin?
Yeah, so I think that's why he's shifted more to the preferreds because you never actually have to pay back the preferreds, right? The perpetual instruments. On the converts, the idea is that they will just convert out into equity. So those are typically 5-year deals. And his bet is like, hey, over any 5-year period, Bitcoin is going to be higher than it is today because historically, over a 5-year period, Bitcoin has always been higher. Like if you bought Bitcoin at the very tippy top peak in 2017, well, 5 years later, or at some point in the 5 years, it made a new all-time high, right? Same if you bought at the peak of 2021, same thing.
But that's kind of short-sighted. I mean, we're talking about 125 years of history in the stock market, right? and we're talking about 15 years for Bitcoin, roughly, give or take. There's and I agree with you. Yes, every 5-year period since Bitcoin's come to fruition, it's been higher so far, right? And we can go through very long periods of history where every 5-year rolling return of the stock market was positive, except for those couple of decades where they weren't, right? So, I guess, and that's my question about risk for microsailor. If I'm, and MicroStrategy stock has not been performing great lately, right? It's well off its peak. And at some point, I'm just curious when investors go, this isn't working the way I thought it was going to be. And then that causes MicroStrategy a real problem.
Yeah, and so I think that is why he's shifting away from converts to preferreds. Mm-hmm. And actually, I mean, I've talked to him and he said this much. So, I guess I'm speaking for him. But he's shifting away from the converts, which do have this bullet maturity, right? There's a date and you got to pay the money back if it hasn't converted. And so his thinking is just at that point, I can issue another convert if I need to and roll it if, God forbid, the price is still, it hasn't converted out into equity. But, that is why he's shifting to those preferreds to get, essentially unlimited maturity there. Mm-hmm. But his view is that with Bitcoin, there's only ever going to be 21 million. It's a fixed supply. And everything in our world is debasing, right? I mean, there's the debasement trade is kind of a new narrative out there. I think, I don't know, Ken Griffin maybe said it. But the point is like the problem for Bitcoin and then therefore for MicroStrategy is that central banks around the world all of a sudden become responsible and they say, you know what? No more credit expansion, no more monetary expansion. We got to rein spending in. We got to balance budgets. We got to, stop debasement. That's essentially what you're betting will not happen. Mm-hmm. And so I think that bet goes beyond, 125 years. And it's in some ways it's a gold bet, similar gold bet, right? Fixed supply, although gold, they're mining more gold, so it's not exactly fixed supply. But the same thing kind of applies there. I think it's this bet on, hey, over a long enough time horizon, central banks will debase. And so Bitcoin, a fixed asset, will therefore go up. And so for him, I think the preferreds are really about just stretching out that timeline so that a 5-year window is no longer his kind of concern period. It's this long window, but I think he thinks that he believes in the message of Bitcoin.
But you brought up an interesting point because you said there's only 21 million Bitcoin available to be mined, and okay, so first of all, there really is no such thing as debasement because you can't debase the fiat currency. You can cause, inflation reduces the purchasing power of currency, but you can't debase it, right? We can remove a little bit of the paper from a dollar bill, but it'll still buy a dollar's worth of goods. I can debase gold, right? I can take an ounce of gold out of a bar and it will be worth less, right? So that is debasement. But you can't really do that with fiat currency. We can, and so the issue with Bitcoin is like, well, there's a fixed supply. I can't print any more of it. But the question is there's infinite fractionalization because I can fractionalize Bitcoin to an infinite degree. So I can keep literally fractionalizing the 21 million Bitcoin into infinity as long as there's demand for it, right? So how is that actually different than just printing more money?
Sure. So the important point is if I have, let's say, we'll use the Michael Saylor example. Let's say he's got 2.1 million Bitcoin. He's got his 10% slice of the pie. That's what he's got. Mm-hmm. You can fractionalize the Bitcoin. I mean, the smallest fraction of a Bitcoin is called a sat, a Satoshi. It's 8 decimal places out. And so it's, I don't know, something like 2,000 sats per dollar right now.
Right.
So you can fractionalize it and he can fractionalize it and he still has his same slice of the pie. The problem with the fiat world is when the inflation occurs, it's not evenly distributed, right? Mm-hmm. So if it wouldn't be a problem, be zero problem with inflation if every time they printed money, they deposited if they added 10% to the supply of dollars, then my bank account all of a sudden got 10% more dollars, and everybody's bank account got 10% more dollars. Great. The inflation was evenly distributed, right? More was created, was spread around evenly, and so no problem. But that's not what happens.
No, that's actually exactly what happens, because all money is lent into existence. So if I am going to if the government is going to create money, they have to basically sell bonds into the market. So they create money through lending, and then in turn banks loan money into the world. So when the government issues debt to pay for excess spending, that money winds up into the bank accounts of corporations, households, et cetera. So there is a accounting equation that exactly matches exactly what you just said, which is that inflation in that form is equally distributed, because when the government creates money through issuing of debt, it winds up on the balance sheets of households.
So it can wind up on the balance sheet of households, you're right, but it takes a bunch of steps, right? It takes a bunch of hops. And so the US government can borrow at the Treasury rate, but for me, when I want to borrow to buy a car, I got to pay, 10%, right? And so the further out the curve you go, the more I have to pay to get access to that new money. And so what happens is it enriches the people closest to the money spigot, right? And that's why.
Okay, I see. Okay, now I see. I understand where you're going now. Okay, got it.
Yeah. And so that's why, DC, I believe like Fairfax County or whatever, the county where DC is like the highest concentration of millionaires in the entire US, or like some, top 2 or 3, right?
Got it.
It's like, why are all these government people super close to the money spigot? Wall Street also, like the banks don't actually make anything, right? But they're pretty close to that money spigot as well. And so they can borrow and then lend out and capture the spread. That's what the banks do. And so by the time it gets down to, like I grew up in Tomball, Texas, I think pretty close to where you are.
Not too far.
By the time it gets to, the guys out in the oil field, or the ranchers or the farmers, it's taken 15 hops, and they are much more disadvantaged in terms of getting access to that than the guys, than Jerome Powell at the Fed, or people in the Treasury who are borrowing. So that's kind of.
Gotcha.
Yep.
No. Okay. So yeah, I understand where you're going now. So all right. So let's shift gears now a little bit from. So we kind of understand what Microstrategy is doing. Got that. Now, how is that different? Because the kind of the new thing that's coming, and we've talked a lot lately about stablecoin issuance, and how stablecoin issuance can actually be a benefit to the Treasury to build those stable coins, and how does that relate to exactly what you're doing with your ventures on your side and what you're building?
Yeah. So. We've built our Treasury business on Solana. And the unique thing about Solana is we can take the MicroStrategy playbook, great, but then we can layer on a giant additional section of plays, because Solana actually generates yield. So there is inflation in Solana. Right now it's about 4.2%. But it's not entirely evenly distributed. It's only distributed to the people that are staking, and some people, for various reasons, don't stake.
Can you explain that? But I'm sorry to interrupt you, but can you explain that for me? That's a term that gets thrown around a lot, and if you go into Coinbase, right, it'll tell you if you own Bitcoin or Ethereum or Solana, it'll say, you can stake this and get a percentage rate of return on that staking. But I don't think a lot of people really understand what that means and how it works.
Yeah. So Bitcoin does not have staking. Bitcoin is what's called a proof of work coin. So if you want to create more Bitcoin, you got to do the mining stuff. And I'm sure you've seen that. The giant data centers, the machines that are super loud and hot, they whine like a bee or something. That's mining, that's Bitcoin. For Ethereum, for Solana, for a lot of other assets, they use a mechanism called proof of stake. And so rather than having a bunch of energy, a bunch of machines securing the network and running the network, you actually just use the existing coins in the network that are like delegated or attached to these different servers to secure and protect the network. it's kind of two different ways to do things. One is energy, one is just the coins in the system. But in exchange for kind of attaching your coins to these machines to secure the system, you get the inflation rewards. And then you also get the transaction fees. So whenever I send some stable coins or anything else around, or I do an action on the chain, I pay a small fee, and that fee goes to whichever machine at that point in time happened to be validating those transactions. And then the machine, the computer takes all of their transaction fees that they collected and pays it out to their stakers. And so you're on Coinbase and they say, hey, you can stake. You basically attach your coins to that node, that machine, and then that allows Coinbase to, validate more of those transactions, get more of those fees and those rewards, and then they pay them out minus a fee to everyone who is doing the staking.
So do I lose access to my, if I stake my Solana as an example, do I lose access to my Solana coin from it appreciating in value or from spending it or whatever else I want to do with it?
So you do lose access. Now you don't, if it appreciates in value, it's still one Solana, right? So whatever that's worth, that doesn't change. But for while it's staked, exactly right, you're not able to spend it. You have to unstake it first. And the unstaking will take up to 2 days on Solana. And so you've got a bit of a wait there. And so you're like, all right, I want to spend it. I want to sell it. Well, you got to unstake it. You got to wait 2 days. And then you can sell it or send it around or do what you want. So there's kind of this opportunity cost, this time value a little bit there.
So, and again, I'm just trying to get you to explain this. So for people that may not be familiar with what staking is, just so they have a better understanding. And so how are the rewards paid out? Like for instance, I've seen, rates as high as 10, 12, 14% on some of the stakes on some of these coins. Is that paid out in the coin itself, or is it some other form of payout? How does that work?
Yeah, it's all in the coin itself. And so, you just are accumulating more of the same asset that you hold. And the payouts are typically based on the inflation rate. So some coins have a really high inflation rate. And so you're like, oh, this is so great. I'm getting 25%. But it's like, well, yeah, but so is everyone else. So like what's happening to the value, Right. And so, but going back to that earlier conversation about like the inflation being evenly distributed for everybody, everyone can stake if they want to and evenly capture that inflation. And so it's this really fair system in that way. But it is paid out in the coin itself and compounds over time.
Right. So how if I'm looking to stake a coin, am I looking for a specific, is one coin better than another in terms of staking, or are they all kind of equal? In other words, you just kind of made reference like, oh, I'm getting such a good deal at 25%. Is it necessary that I want to find the coin with the highest payout, or am I better off, say, with a coin that only stakes 10%?
Yeah.
And how do you determine that, I guess?
Sure. Ultimately, you want to, you want an asset that you think will appreciate over time, right? So if you're getting 25% more of something that's going straight down,
it doesn't really matter.
Right. Like, I mean, you don't want to just go buy the highest yielding dividend stocks because like, oh, this thing's paying 10% dividend. It's like, well, yeah, maybe it's 10% because the stock is down 50%. And so like the trailing dividend yield is up a lot. And so, crypto assets, the successful ones, say Bitcoin has gone up, hundreds of percent a year annualized. So a 10% yield on top is like, it's nice. It's a cool extra, but still the most important part is the price appreciation. And so if you're going to invest in the network, you really want to, understand the build out and the use cases and what's the thesis for why the coin will go up long term.
Right. So in other words, like with all assets, know what you own and why you own it and make sure it's a good quality asset with a future.
There you go.
So yeah, it's just kind of fundamental investing back to this point. So all right, thank you very much for going through that again. We talk a lot about staking and in the media and stuff, and I just don't think a lot of people really understood what it meant. So I appreciate you taking a moment to explain that. But now, so back to digital asset treasuries and what you're doing. We started that conversation mentioning staking, and now proceed from there.
Yeah. So we built our business on Solana because we think Solana is behind Bitcoin, the second most exciting crypto asset network or crypto network. And that's because you're seeing a lot of development innovation happen on it. So the growth in stablecoins is primarily happening on Solana. The usability is, rapidly expanding on Solana. You've got tokenized assets, stocks, bonds, all these things being used, traded, moved around on Solana. And so Solana as a network for crypto infrastructure is rapidly expanding and growing. And that's because it can handle transaction throughput similar to, say, a Visa or PayPal or some other well-known payment network that you have out there. So it's able to handle the scale. And yet Sol, the coin, is only about $100 billion asset, which, hey, that's pretty big. We think $100 billion is a pretty big company. But when you look at Bitcoin at, 1.6 trillion and Solana at 100 billion, I don't think Solana is going to flip Bitcoin per se, but there's a pretty large delta there. And you can't do any stable coins on Bitcoin. You can't use Bitcoin for payments. You can't do tokenized assets on Bitcoin. Bitcoin doesn't really serve as an infrastructure for anything other than sending Bitcoin around, which is great. But Solana has all of this upside potential. And so when we were thinking about launching our treasury strategy, we wanted to build on an asset that we thought had the most long-term upside potential. So we have this thesis that over the long term, let's say the next 10 years, we think Sol, the asset, is going to 10K a coin. Right now it's at about 200 a coin. And that's because it can replace a lot of the financial plumbing that currently exists in the economy today. So all your wire transfers, all of your ACH transfers, your Venmo transfers, and then multiply it all across the world. And then when you add in, small transactions between AI, agents and robots, there's all these new forms of payments that are going to need to be built out. All of this stuff is going to go, in our view, is going to go from the legacy, wire payment system, people in the back room moving paper around, to these global digital systems. And that's why, for example, Stripe, one of the largest payment processors, they bought a stablecoin platform and a multi-billion-dollar deal. And the depths of the last bear market, they made a huge bet because them, as one of the leading payment providers, see a lot of this stuff moving on chain. And that's just because of all the benefits of building payment systems and value transfer systems on top of these systems, of these crypto networks. And we believe Solana is the best crypto network, has the most upside to kind of capture this new wave, if you will.
Right.
So we wanted to build our business on the fastest horse, if you will, the fastest rocket, attach ourselves to that. And so our business is built around essentially accumulating Solana as quickly as possible. So we copy the Microstrategy playbook. Great. We've issued convertible bonds. We're going to issue a preferred stock offering that's filed already as an S1. We've been running the ATM to raise capital. But as an additional piece on top, we actually historically, we've generated about 10% yield on our Sol holdings, which is very unique relative to, say, a MicroStrategy, which doesn't generate any free cash flow off their Bitcoin. So we can stake it. We run our own validator in-house, so we don't pay third-party fees. And there's a bunch of other stuff that we can do in the DeFi ecosystem to grow our Solana per share. So our North Star key metric is Solana per share. That's the main thing we focus on. And so for our shareholders, we want them to be able to put in a dollar of investment today, and then over time that will represent more and more Solana, into the future. And so what we've done is we've actually built an operating business on top of Solana that we generate revenue from, we have free cash flows from, we have earnings, we're cash flow positive. So you can value our business on a PE ratio if you want, or a price to sales ratio. You can use all the metrics that you might use to value a tech business on our business, but instead of GPUs or data centers or maybe trucks or ships or whatever asset, we just happen to use Solana as our asset that we use to generate revenue. And so while it is somewhat similar to MicroStrategy in some ways, it's also more similar in some ways to a tech business because of this revenue component to what we're doing. And so it's been a really interesting kind of build out of the playbook. And it feels like over time, the MicroStrategy piece gets smaller and smaller, and like the new piece, the DFDV specific piece, gets bigger and bigger, which is pretty cool.
No, that is very interesting. And again, it's, one of the things we've talked about before is that, we haven't seen yet, we saw very, very briefly, we saw, Tesla as an example. They talked about, taking Bitcoin to buy a car. And that didn't last very long because of the volatility in Bitcoin. So they stepped out of that. And so one thing we haven't seen yet is a big mass adoption. Again, you mentioned Stripe, which is absolutely right. There is the PayPal, Stripe, kind of these other payment systems, are definitely looking at blockchain assets in order to accept payments and do these type of things. But at some point, you're going to need the major banks. You're going to need JP Morgan, Goldman Sachs, these guys to step up and do this, consider the drivers of most of the global transactions to kind of meet your goals. What happens, if they choose a different asset, or what happens to you if they choose Solana? I mean, what's your risk going forward in terms of your game plan?
Yeah, so I think in terms of adoption, there's a couple components there, but absolutely right. People don't want to buy things with Bitcoin because it's too volatile, but people do want to buy things with dollars, right? And stablecoins are just dollars, digital dollars. So like, that's great. I think it would be great to have the major money center banks get on board. However, the whole point of the stablecoins is to eliminate their kind of stranglehold on payments. And so if we need to pay contractors in a certain, internationally, we mostly just pay people with stablecoins. Like, oh, send us an invoice for, $5,000, and they have an address on there, and we boom, just send it. Much prefer that over wire instructions, and we got to call up our bank and then do the wire, and it's international and charges fees, and it takes 5 days and whatever. And so the whole point of stablecoins is actually to route around the major money center banks. And so what you're seeing is, and this is why Stripe is so excited about it, because they are tied to the money center banks, and Visa and PayPal. PayPal is a large stablecoin themselves, PYUSD. These guys, these payment processors that touch the end users, they want to cut out the middleman, right? Right now, they're all relying on JP Morgan, on BNY Mellon, on these guys to like settle things in the Bank of International Settlements for international payments. But Stripe owns the users. PayPal owns the users. Venmo owns the users. Cash App. So they're like, why are we paying all this to the back end for bad service, for the potential to be deplatformed, for all these things? Let's just cut all that out and let's go direct. Let's allow someone to go straight from Cash App to Venmo to Revolut directly without having these middlemen. And so they can add this stablecoin layer and cut out the middleman. And the end user doesn't need to know that they're using stablecoins, right? The end user is not going to be running around like, oh, I love stablecoins. Like, stablecoins are so great. They're just like, oh, cool. Look, in my Cash App, like, there's this sweet new feature, and I can pay my friends anywhere in the world for free. This is great. And so it's this back-end plumbing and infrastructure that enables these large tech companies to build these payment solutions in a way that's lower cost, lower friction, and users aren't going to know or care that it's like on this crypto rail versus this weird bank thing, whatever.
Yeah. And because again, to your point, if I'm on Venmo and I send $25 to my daughter, I don't realize that in the price, and she gets $25 on the other end. In the background, it all happened in stablecoin. She just didn't know it.
Yeah, exactly. It's like, it's just $1, whatever. When you send right now Zelle from one bank to another, you don't know that there's like this ACH thing and how the clearinghouse works, and there's like net settlement, and then that all flows down to accounts at the Fed. Like, you don't know any of that. You're just like, well, I just like texted some money from Zelle to my friend and it worked, like great. And so this is just a better way for it to kind of just work.
Yeah. So this is where my conspiracy theory side comes out, which is,
Let's hear it.
Well, I mean, you talk about the size of JP Morgan, the size of BNY Mellon, the size of Citigroup, the size of, these are major players in the financial system. They're not going to go down without a fight, right? So, and they have influence with the SEC, with the federal government, because they pay billions of dollars to lobby the government. And they can create regulation that potentially hampers a lot of this development to a large degree to keep that. Look, they're not going to, like I said, they're not going to give up their fight, right? Or they're not going to give up without a fight, I should say. And so what's that risk look like in the future? I mean, again, if everybody starts trying to go around the major banks, which I agree is a good thing, by the way, completely on board with you. But it seems to me that there's a regulatory environment risk somewhere down the road.
I think there could be future fights, but I think, politics aside, I think the Biden administration or certain members of the Biden administration really went after the crypto space. I mean, Elizabeth Warren was supposedly this bank hawk, but I think, she's been taking a lot of money from the banks. And she and her pal, Gary Gensler, were absolutely out to crush this space. And look, the crypto universe band together and by and large got behind Donald Trump, not because maybe they're huge MAGA guys, wearing the red hats and stuff, but because he promised to basically remove this all-out assault on crypto.
That's right.
And I think, Scott Bessent at the Treasury, he understands the value of digital dollars, where essentially you have people all over the world that have not been able to get access to dollars, it's very difficult, now have much easier access to dollars. And so stablecoins help to export dollars around the globe, which really helps with, our ability to print money and, service our debt and all those things. And so, there was the Genius Act, which was a stablecoin bill that made it through Congress. It was the very first major piece of crypto legislation to make it through Congress, and it passed. And this basically set the rules of the road for stablecoins. And since then, the banks have been writing some letters, hey, we need to change this or that because this is a risk to the banking system and whatever. But, what's pretty wild is that the largest stablecoin issuer, Tether, is, I think they're like at this point now, the 5th or 6th largest holder of treasuries. So they own more treasuries than any of the major banks. They own more treasuries than the country of Germany. And this year they're on pace to do, it's like 15 billion or 20 billion in net profits. So they are far more profitable than, I think, pretty much all of the major money center banks. They do about same amount of profit as BlackRock, I believe it is, but they are a major player. And so I think some people are like, oh, crypto, like it's the small guys, the big banks are going to come in and crush them. Actually, some of these crypto entities are larger and more powerful than the banks at this point. And there's a major national interest to see stablecoins succeed that I don't think the banks can really push back against. And so
I absolutely agree with you on that point. And, again, at some point, the major money center banks are going to have to just come with a game. I mean, the future is clearly heading to where you're talking about. So it's just a function of time until the major money center banks adopt the technology and implement it. They're just, they're the Titanics. It's going to take a very long time to turn that ship. And the risk that JP Morgan runs, as an example, is losing market share to an up and coming system that they're, maybe already in the works with Stripe or payments or PayPal or some other, or some new company that's coming up like yours that, takes advantage of that space that people want, that they just cannot adopt fast enough.
Yeah, and look, this is the creative destruction of capitalism that, America has been built on and the West has been built on. is innovation that disrupts the incumbents that have maybe kind of gotten a little chummy and elbowed out their competition with some regulation or whatever, and hurting their customers, their users. And so like this new technology is coming in to make the world a better place, and they can get on board with it, or they can try to fight it. But I think it's inevitable at this point, like.
I absolutely agree. Let's get ready to wrap this up here real quick. Just a couple of kind of rapid fire questions. So just kind of keep short answers. What are just 3 things you want our listeners to take away from today to remember about digital asset treasuries?
Yeah. So I would say, make sure the thing is built on an asset that you understand. Right. So know what you own, as you talked about. Mm-hmm. If you buy a treasury vehicle that's holding an asset, you need to understand that asset. So that's step 1. 2, for a digital asset treasury, you want to make sure the management team knows what they're doing. They're fully aligned with the shareholders and they understand the space. They've been in crypto for a long time. And then 3, you want to see their track record, their execution. And so over time, them running this treasury vehicle, are they doing what they say they're going to do? Are they transparent? All of these things. But ultimately, a treasury vehicle is just a better way to own an underlying asset. So if you like Bitcoin, you should love Microstrategy. If you like Solana, you should love DFDV. And that's our view.
Yeah. And DFDV, by the way, is basically Parker's company, trades on the NASDAQ. So if you want to go check out the stock, that's DFDV on the NASDAQ. There's a lot of material today, and probably going to have you back at some point just to talk about things as they continue to develop here, as things change. So certainly we'd like to have you back to have further discussions, but it's been really great spending time with you today. If you'd like to learn more about Parker White and what they're doing with Solana and their digital asset treasury, go to dfdv.com. That's also their symbol that trades on the NASDAQ, so you can go do research on the company there as well. And again, Parker, thank you so much for coming today. Any last words for our guest?
Thanks for having me, and super excited to answer any questions that your audience has about digital asset treasuries, about crypto. Come check us out. We're on Twitter as well, Reddit. I'm more than happy to answer all questions crypto.
Well, maybe what we'll do is next time we'll have you back and we'll do a live audience at that time, and we'll just let audience ask you questions. How about that?
Sounds fantastic.
That'll be awesome. Thank you so much, Parker. That concludes our Real Investment Show interview series update for today for the Real Investment Advice. Go by the website. Be sure and like and subscribe to the channel. Get by the website, realinvestmentadvice.com. Send us your questions and comments. If you have questions for Parker, send them to me. I'll be happy to send them over to him as well. So again, realinvestmentadvice.com. Be sure and like and subscribe to this channel, The Real Investment Show, and we'll see you here on the next edition of The Real Investment Show. Have a great day.